We're 90 minutes before the open on Tuesday, January 18th. Hello, traders. Yes, I almost said Monday. That holiday's got me all screwed up. The market is currently down about 50 S&P points, so I want to keep this video moving quickly. Let's see if we can find some opportunities. Let's get our market bearings. That's the most important thing that we can do. I'm not going to review my previous video because I've been focusing on selling out of the money bullish put spreads. I'm going to also do that in this video. We're going to talk about why the strategy should work in this market environment, why I believe the 100-day moving average is going to hold. However, I don't like what I see on the horizon, and I've also been very vocal about this during the course of the last couple of months or so. So let's take a look at the market first. We've got the S&P 500. You can see this upward sloping trend line right here. This is a support level that's going to be breached this morning. So I'm going to put up the major moving averages, and we can see where the 100, 200-day, and 50-day moving averages come into play. And there we can see that the 100 moving average was not quite touched here. Almost, but we just missed it by about 10 S&P points. This morning we are going to test this upward sloping trend line at 460. So that is a major support level. So now all of a sudden we're seeing the market test this 100-day moving average with greater frequency. I referenced this last week. We had gone months and months where we would test the 100-day moving average and then rally off it and never look back over the course of the last few years. Now we look at it and, oh, whoa, wait a minute. There's some sustained selling in September. And we spend time below the 100-day moving average. Haven't seen that in quite a while. And then we lift off. Almost another touch, another touch, another touch. This is 3 touches in just the last couple of months. That is also not characteristic of a market in the last couple months of the year because we typically see seasonal strength. When we don't see that seasonal strength, it's a warning sign. So yes, Omicron is going to weigh on economic activity. That could be a possible problem. I feel that that is discounted. We also have the Fed ready to raise rates. We're going to take a look at the TLT because that is also very important. As I've mentioned to you, in selling out of the money bullish put spreads, you do not want to focus on tech stocks. Why not? Because when interest rates start to go higher, the tech sector is the one that carries the brunt of the blow, and those stocks are typically very, very weak when you've got rising interest rates. So you can see how TLT is right on, and this is the US 20-year bond that is right on that 141 support. As bonds head lower, interest rates go higher. Higher interest rates, not necessarily good for the market, although I will also put a caveat to that. The initial reaction when the Fed starts to tighten is not good because the asset managers are worried that the Fed is going to tighten too quickly and that it is going to squash economic growth. But right now, we've got inflation that we haven't seen since the 1980s. About 40 years it's been since we've seen inflation this high. So, got to watch the TLT if we break below this support level, and I believe that we will because the Fed has been hawkish and they're talking about 3, maybe 4 rate hikes this year. That's changed since just September when they were talking about maybe no rate hikes. So interest rates are heading higher. They have to, simply because of inflation. The Fed does not control inflation. So we've got inflation starting to pop up. We've got Omicron. We have another issue. There are economic data points coming out of China right now. We know that their GDP is showing a 4% growth rate. That is substantially less than what we've seen out of China in the last 10, 20 years even. And it's decelerating. The rest of the world, the US, Europe, we're kind of holding our own, maybe inching our way higher a little bit. But in China's case, the growth is definitely starting to fall off fairly quickly. Some of that is the virus. Some of it is supply disruptions. Some of it is the real estate market. And you know I've been pointing to China and the FXI since last year, the middle of last year. Why is their market down so much if China is the global growth engine and if everything is coming out of that doldrum that we had during the pandemic? Well, if China's leading the way out of it, I sure don't see it in this chart because you can see how Chinese stocks have been down, down, down. Second largest economy in the world. This is a big red flag. Their retail sales came in at about 1.2% growth. China usually averages like 8 to 10% growth year over year in retail sales. That is a dismal number. That's a problem. So again, think about the global growth engine, not so much showing some real signs of strain. So, Pete, why are we selling out of the money bullish put spreads? It sure as heck sounds to me like you are pretty bearish in here. I feel that over the course of the next 2 weeks, earnings season is going to be pretty decent. Typically, sellers are not that aggressive when you've got mega cap tech earnings coming up. And these mega cap tech companies, to a large degree, have been isolated from supply disruptions. It's because they are technology companies and they have social media platforms, search engines, whatnot. I think their earnings are actually going to be quite decent, but that's not representative of the rest of the S&P 500, where I believe higher hourly wages are going to bite into profits. This morning, Goldman Sachs came out. They missed their number. To a large degree, higher salaries were one of the issues that they cited. This is one of the largest input costs that companies have, 0.6% wage hourly wage increase in the last unemployment report. So that is also inflationary. CPI, PPI, PPI not so much, got a little bit of relief on PPI, but CPI came out super, super hot. Again, inflationary. So this is a time to be very, very cautious. You can look at the fundamental news like I've outlined, higher interest rates, China, economic growth. That doesn't paint a very robust picture, or you could just look at the chart and see that over the course of the last couple of years, let's zoom out very quickly, and we can see that this is a nice rally, and the dips had been very, very shallow and brief. Now they're getting a little bit more sustained, and that you need to be able to pick up from the charts. Those are the tea leaves that you need to be able to read. So yes, I still believe that 100-day moving average is going to hold. I like this horizontal support line also coming into play at the 100-day moving average. Put up the crosshair. There's your prior resistance. Now that becomes support. Touch, touch, and the 100-day moving average in there. That level is approximately 455, let's call it, on the S&P 500 SPY. So I think that's going to be a pretty decent support level. Yes, could we go down and touch it? For sure. But that's why we're selling out of the money bullish put spreads. We want to distance ourselves from the action. We want to focus on strong stocks. We want to let time decay work its magic on the notion that if we come down and test this 100-day moving average as we get into earnings season for the next couple of weeks, the market will be able to, at minimum, tread water there, maybe inch its way higher, and those spreads will expire worthless. Then we'll reevaluate. We'll determine what our next course of action is. I don't particularly like what I see in the market here, though. So I'm going to be pretty cautious after 2 weeks. And the next big window, the next potential big speed bump comes a week from tomorrow when the FOMC statement is released and all the mega cap tech companies report earnings. So ride your bullish put spreads. I'm not suggesting that you put any new ones on. I think you got to be very cautious with them. We were putting them on a week and a half ago. We were putting them on a week ago. And at that point, I said you should have your positions on. Time decay should already be working in your favor. So the first thing about bullish put spreads, market first, market first. We don't mind if the 100-day moving average gets tested, but what we don't want to see is continual closes below it. This would be a bearish sign and a sign that we may need to reel in some of those bullish put spreads. The stocks that you're focusing on should not be tech stocks. They should be stocks that have really nice relative strength And let's go through this list. We can go into Pop Bull. That's one of my favorites. WY was a stock that came up last week. This is actually it's Win, excuse me, covering up the rest of that symbol here. So let's take a look at this. And you can see Win through this horizontal resistance, through the 100-day moving average, upward sloping trend line. Everything looks good on Win. Earnings on February 3rd. The only problem I have with Win is that it's not a particularly strong stock. You can see how it's in kind of the lower right-hand corner of the chart, and it has exposure to China. So I don't like that in particular either. But if we go into Pop plus Bull, what's the difference between the two? These stocks were on the list Thursday. These stocks were on the list Friday. So this gives me one more bite from the apple. And as I look through the list, these are going to be some excellent swing trading picks. Let's take a look at the charts. AMAT, yeah, pretty decent. Love that support line right at the 145 level. You've got support at 155. Yes, this stock could be good. Look at that big bullish engulfing candle on Friday. Any pullback on this stock? Yes, it is a technology stock. There's a huge shortage of chips right now, and AMAT will benefit from that. So Win in Las Vegas probably had pretty decent Macau results, and that's why it's rallying. Bang, I like this horizontal resistance. Now support right around the 117 level. Look at that stock move higher. Put up your relative strength indicator. And there you can see, orange line above zero, beautiful relative strength. That's the type of bullish put spread that you want to sell below that 117 level. There are buyers. Why are there buyers in this stock? Because basic material prices are going higher. These are producers. They have pricing power. As inflation goes up, they're going to raise their prices. And there are supply shortages. So they are in a very, very enviable position right now. DWAC, EOG, another really nice one. Through that horizontal resistance, if you can sell a bullish put spread down around the $95 level. So let me reiterate another point. Pete, the S&P futures are down 50 points. You're telling us to put bullish trades on. I believe that 100-day moving average is going to hold. Any pullback I see in a stock like this is going to be a buying opportunity, or at least an opportunity to sell out of the money bullish put spread. So when the market's down 50 points, I'm looking for EOG to give up some of those gains. That will help us get those out of the money bullish put spread fills. So we need to have a market pullback on a stock like this, or else it's just going to continue to go higher. COP. So we're getting into a lot of uh, energy stocks. Energy's been super, super strong. You want to be in the strongest sectors. You can see Wells Fargo, excellent earnings reaction last week. Any kind of pullback in here, which I think you might start getting in banks given Goldman Sachs news. You can get down to this 52.50 level. You're going to need a pullback in this stock, probably to about $55 to get a decent credit for that. But earnings are out of the way. So, yeah, that looks good. Here's another semiconductor stock. Very nice breakout. There's your technical was resistance. Now it's support. Earnings out of the way. Anything around that 128 level, I think will work really well because you'll be inside of that high. You'll have added protection. Support, support, support. Look for those multiple levels of support, then sell your out of the money bullish put spreads below them. VLO, these are the stocks you want to focus on. Caterpillar. Guess who Caterpillar sells a lot of their equipment to? Energy producers. So yes, Caterpillar has actually done very well also. Take a look down this list. You've got Dell, not good. Intel, not bad. Trying to get through this horizontal resistance, but we've already seen better patterns in TSM and AMAT. So if this belongs to the same group, why not go with the fastest horse? So those are all pretty decent candidates. SLB also. DISCA is Discovery. That's actually got a beautiful little breakout right in here. You can see how those gains held last week. It's through the 200-day moving average. Yeah, I like that. Volume decent, excellent relative strength. So let's shift gears. Let's see what we've got on the bearish side. and I'm starting with swing. I could go into my day trading searches, but right now it's before the open, so I know if I go into my swing trading searches, I've already got a stock that's setting up well on the short side on a longer term basis. Then all I have to do is wait for my daily charts, my 5-minute charts to line up, and then I know that when I enter that trade, it doesn't have to be absolutely perfect, perfect, perfect. I've got that tailwind because I know on a swing basis the stock is weak. So let's take a look at some of the candidates here. Beautiful breakdown through horizontal resistance on HD. Now, it's a little late to get in on this move unless it gets below that 100-day moving average. Then you've got another opportunity, and that's how I address it. I click alert and I drop my alert line right there. If it breaks through this, I'm going to know about it, and then it will be comfortably below that 100-day moving average. So it's checked this entire breakout right in here. Nice compression, breakout. Now we're all the way back down to that support level. Yeah, I think HD is looking pretty weak in here. Lily, upward sloping trend line. You can see that visually. Comes into play right at that 100-day moving average. We're below it now. This is a nice short relative weakness. See how easy? PayPal could be a decent short breaking this horizontal support right in here, but it's been pretty choppy and pretty compressed. I don't see a lot of momentum. If it puts together a nice red candle through that low, yes, all of a sudden it becomes of interest to me. Let's go in and take a look at Pop plus Bear. These stocks would have come up a couple days ago. Let's go through this list and see what we've got. Costco, fairly weak. You can see I've already got my alert line drop below the 100-day moving average, which incidentally, let's talk about a search. 1050 bearish, 10100 bearish, 10200 bearish. These are searches you will want to use because the stock closed above the 50-day moving average, and right now it's below it. The stock closed above the 100-day moving average on Friday. Now it is below it. The stock closed above the 200-day moving average Friday. Now it is below it. Once you get these major technical support breaches, these are the types of stocks that you want to start keeping an eye on. Here you can see. See how easy? It's got to be easy. We're trying to find trades and we need to be on these stocks right away. So that's what Option Stalker does. It makes it really easy for us to find these opportunities. So you get a 200-day moving average breakdown. You add relative weakness to it on a 5-minute basis. You add heavy volume to it on a 5-minute basis. You've got that stiff tailwind that you need when the market is selling off. So those all look like decent candidates. Let's go back into Pop Bear real quick and take a look at anything else. That's a nice short. Horizontal support, very weak, continues to fall, big volume, continuing to move lower. ZM, drifting lower, not bad. Here you could draw a downward sloping trend line, selling out of the money, bearish call spread. That would work for that. And I'm just going through to see if there's anything else. Affirm, nasty breakdown below the 200-day moving average. Can't get going. You'll notice that on the bearish side, we've got a lot of tech stocks. That sector is starting to really give up some of its gains. That's how we find them. I'm not going to spend too much more time on this, but I do want to go into QQQ and we'll take a look there. So here's the S&P 500 in the screen here. You'll notice upward sloping trend line still intact. Okay, we're all good. There's the 100-day moving average. Oh, we've got quite a ways to go before we even test the 100-day moving average. QQQ. Uh-oh. Down below horizontal support, below the 100-day moving average already. Relative weakness, heavy volume. So when you're looking for bullish put spreads to sell, this has to be part of your analysis. Do I want to be in the tech sector? Heck no. If I'm selling out of the money bullish put spreads on tech stocks across the board, I'm going to be taking heat. I'm going to be getting hammered. That's why we've been focusing on basic material stocks, stocks that are moving higher to sell these out of the money bullish put spreads on. So one more thing about the market. Yes, we're testing these major support levels. You do not want to be shorting a gap down. You need to give it some time to see what is going to be unfolding this morning, because oftentimes on a big gap down, you are going to see a bounce. On that bounce, we want to evaluate what the heck is going on with the market. What do the candles look like? Is this a sustained bounce? Is this something that's going to be given up very, very easily? You'll have that information in 30 minutes. When you've got a chart like this on a weekly basis, you do not want to be out there picking tops, folks. I know it's going to be super tempting to buy puts this morning. People make a lot of money buying puts because the market takes the elevator down and it takes the stairs up. Yes, but when you have this kind of trend right here, know that buyers are not just going to go away. They are going to support this type of move, and dips are going to be viewed as buys. Every dip is going to be a buying opportunity until that changes, and it takes a long time for a rally like this to turn into a sideways range. Months. It's a 12-year bull market rally. So you have to expect that early in the day, you're going to get an attempt to rally the market. Let's go into the 15-minute chart. Let's see what we can find here. I'm going to be looking for a gap down. Well, hey, there's a perfect example. Last Friday, market gaps down. Follow through from selling that we saw Thursday. Uh-oh, market gaps down. Better buy some puts, buy some puts. What happens? 30 minutes later, you are bummed out because you were all excited about how much money you were going to be making on the short side. And then, uh-oh, dang. I got to get out. Oh my God, I got to get out. Look, we filled in the gap and now we're above the gap. Everything looks great. And you panic out of the position. Had you waited just a little bit, you could have evaluated this bounce and gone, okay, we got some nice stacked candles in here. This looks good. Got a little overlap. That means that the trend strength is not strong. If we had seen green candles stacked like this, very little overlap consecutively right here. Okay, I like this a lot better than I like this. And then, uh-oh, here we go, bearish engulfing candle. Well, as somebody who's patient on the open, when I see this, couple of dojis in here, long tails, I'm like, the market doesn't have that strong of a trend going right now. Then I see this bearish engulf. Now I'm like, okay, I'm licking my chops because I'm going to have an excellent entry point for a short position. Here we go. Oh, didn't expect that. That is a nice long green candle. All right, let's see if we get any follow through to it. If we don't, and it's a one-off, that is just trying to attract buyers, and then you get a bearish engulfing candle. When I saw this, I'm like, hallelujah, we're going down, get short. There's your upward sloping trend line. You've also got a horizontal compression right in here. That's a good shorting opportunity, and you've got a bearish 1OP cross. That's where you make your money. This is where you lose your money. I got a short. Oh my God, the market's falling apart. I just got crushed. I just wiped out a huge chunk of my account. Don't be in this camp. Be in this camp. Watch what happens. Short here, cover here, right on that bullish engulfing candle, right on that bullish 1OP cross. Then you can make money. That's all I got for you today. Be careful. Don't short right away. Any sustained decline that we have that drags us down to the 100-day moving average, keep an eye on those basic material stocks. I think some of the bank stocks will do well also because you've got a backdrop with higher interest rates. That's good for them. If you go through and you run your searches selectively, some of the tech stocks that might work are the semiconductors, the AMATs, the TSMs. Those also could work. So there could be pockets of strength within the tech sector. But go through your searches, look for that relative strength, look for those stocks that are in the upper right-hand corner. This is a strategy that'll work. I like being long these stocks just for a couple of weeks. Let's see how all the big tech names fare over the course of the next week and a half. Then let's reevaluate. I think you've got to be really, really careful heading into the FOMC statement on January 26th. And by the way, what makes that a very daunting date on my calendar is the fact that the mega cap tech companies will have almost all reported, Apple being the last one on January 27th. So the air will get let out of the balloon. Sellers and profit takers will be a little bit more aggressive knowing that those big giants have reported earnings. And then you've got the FOMC, which is likely to be pretty hawkish in my opinion. So tread kind of cautiously here with your longer term swing trades selling out of the money put premium. Know that market conditions are changing and that in all likelihood we are going to be spending more time testing these major moving averages and starting to put in a sideways trading channel. And that is how 12-year bull markets, 3-year bull markets are resolved. They don't go straight up and straight down. After a big run like that, you're going to start seeing a trading range at the upper end, and that is your sign of weakness. Please leave your comments. Please leave your questions. Good luck with your trading. We'll see you tomorrow. Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education, so make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.